Good day everyone, my name is Victor Schaefer, I'm the owner of AVS Solutions. Today I would like to talk to you about a very interesting topic. I think it's on a mind of everyone. How to pay off the mortgage 2 or 3 times faster without changing your lifestyle. That means you're not going to eat less or drink less or travel less. Today's days we're not traveling a lot anyways. But you will be able to pay off your mortgage 2 or 3 times faster just by using a different mortgage option. I think it's a revolutionary product. Personally, I'm using this for 20 years or over 20 years. I don't have a mortgage anymore, but there are still advantages to have this product. Both of my kids, which are in financial industry, they're both using this option, and many of my employees as well. So I always say, if this is something that I and my kids are using, that tells you a lot. But before I will start the presentation, I would like to share a couple of minutes about myself, because this is an important topic and I want to make sure that you guys trust the person who is presenting, because you need to know who I am and why you should listen to me. I'm in this industry for over 20 years, and I'm in Canada in a serious position, and I think we have over 20,000 mortgage brokers. In my province, I'm number one for many years, and the reason why I'm telling this to you, just to make sure that you feel comfortable that the person who is going to do the presentation probably knows what he's talking about. Let's just, without any delay, go right in the presentation and discuss the option how to pay off your mortgage 2 or 3 times faster without changing your lifestyle. If I do my events, and I do events across Canada all the time, and I like to ask people in the room questions, and one of the questions actually I ask this one. If you will go to the bank and the bank will offer you 2 options. One, you pay 55% of your payments will go to the bank as a profit at interest rate, and the second option, I will offer you 30 years amortization, 3% interest rate. Which one would you choose? And I get different topics because the people expecting me that there is something behind this question. It's not just straightforward, but the real situation, real answer of this one, it's exactly the same. It's all about how this is presented to the client. If you would get a mortgage and you'll pay it off within a year, yes, then the option number 2 would be perfect because you pay 3% mortgage. But because there's 30 years amortization, you pay actually lots of interest rate, which is actually 55% of your entire payments that you will pay within 30 years will go to the bank, and only 45 to cover the balance of your mortgage. Now, to understand the mortgage option that I will describe to you today, and I will try to do it as short as possible because usually it takes over 2 hours on my seminars, because I start from the beginning to the end, I explain everything. Today is just a brief description of what is product. Hopefully within 15 minutes I will be able to cover everything. To understand the power of prepayment, I want to show you some numbers, because the number one option, the best and the fastest option to pay off your mortgage is do additional payments. But the big question is, how should I do it? Where should I get the money from? And that's what we will discuss today. In this particular case, I will describe your mortgage. Someone has a $500,000 mortgage, 3% interest rate, 30 years amortization, $257,000, and interest rate will go to the bank. That's how much the bank will profit from you. You still have to pay your $500,000 back. That's the balance of the mortgage. But on top of the 500, you will have to pay 257. This is actually a lot lower than in the past, just because the interest rates are so low right now. Now, you need to understand that the number one goal for someone who wants to pay off the mortgage is not to get the best interest rate. On the best interest rate, you're not going to save a lot, but you have to get a mortgage where your amortization will be as short as possible. And here I would like to give you an example. 30 years mortgage, if it's $500,000 mortgage, 3% interest rate, you will pay to the bank as a profit $257,000. If you will be able to pay it off 5 years faster, $209,000. If you pay it off 10 years faster, it's $164,000. If it's 15 years amortization, $120,000. And if you will be able to pay off the mortgage within 10 years, and that's what majority of my clients do, they pay it off within 10 years, you will pay only $78,000. With this screen, I would like to show you that the number one goal of everyone who wants to pay off the mortgage faster is not to get the best interest rate, but to get an option where you pay as least as possible interest rate. And in this case, you see that your goal should be pay off the mortgage as soon as possible and shorten your amortization. if you go to the bank, the only thing they would like you to think about is about interest rate, because it's not the number one concern, but they don't want you to pay off the mortgage faster. We will discuss this. If it's really just about interest rate, then small difference should make a big difference, right? And in my industry as a mortgage broker, that's what we do. We're in nature of business to get the clients the best rates. And because of my status, I have a pretty high status with banks, I get the best available rates in the market. But I just would like to show you with this example that the difference in interest rate, and I'm using on purpose, I'm using 1% interest rate difference, okay? Because usually between us and let's say our competitors, we're talking about rates 0.1, 0.2, and everybody is trying to get the best rate and the lowest rate. But here on purpose, I'm comparing two options with 1% difference. 500,000, 269 interest rate, and you will pay 186,000 interest rate within 25 years, okay? The second option, 1% higher, instead of 269, 369. But the person is able to pay off the mortgage 10 years faster, and guess what? He paid $150,000 in interest rate compared to the person on the left side, 186. And again, I did that on purpose. I compare 1% higher interest rate, which is usually does never exist, such a big gap between the banks or credit unions or broker options. Now, the easiest way to understand why you're able to save a mortgage with this particular option that I would like to talk to you about is I always like to compare the mortgage and simulate it as a ladder. Every step is 1 month's payment, okay? It's your interest rate and your principal. So every month you go up, you pay interest rate, you pay principal. And the big question is, how can you skip the interest rate payments? Principal you cannot skip, you have to pay them, right? But how can you not pay interest rate? And I will explain you with this particular scenario, because you need to understand that there's different, if you just go step by step how the banks want you to do, that it will take you 25 years to pay off the mortgage. Every month you just save a little bit on interest rate and you pay a little bit more principal. But it takes for ages until you reach your goal. So here I just want to show you, somebody gets a mortgage in 2020. In the first month he pays $1,242 to the bank, it's interest rate, and only $860 principal. Okay, now if you look months later, he pays $1,240. So really it's only $2 difference, and you pay $2 more for your principal. And that's the next month. So you see that it's not much difference between every month. So that means you are paying off your mortgage faster every month because your interest rate drops and your principal goes up, but it really takes you a long time. And to say exactly, in this particular scenario, it will take you 7 years until your interest rate payment and principal payment about the same, okay? So it takes you 7 years to be that at least half of your payment will go to pay off your mortgage and half of the payment will go to the bank. And the big question is, how can we speed up the process? Because we don't want to wait 7 years, and we definitely don't want to pay 30 years mortgage. And there's one other interesting part of the mortgage that every person needs to understand. The reason why you pay so much to the bank, because you also pay interest on top of interest. We call it compound interest, okay? If you have investment, it benefits you because your money makes money, interest rate on top of interest rate. But if you have a mortgage, it works against you. So your number one goal should be, by saving your interest rate, you also save on compound interest. And there is also an option where the mortgage is not compounded or your interest rate is not compounded. It's a little bit complicated. I don't want to go in details again. It takes me 2 hours in a regular presentation, and I want to make this short. But just understand that you're not just paying the interest rate to the bank, you also pay interest on top of interest. Okay? Now let's go to our previous example. We use the ladder. Every step is 1 monthly payment. Now, if people are always asking me, who can teach us how to manage the money properly? I always say the best and the easiest way, look at the banks. Look what the banks do. They use more of your money to make money. And with this particular example, I would like to show you how you could use banks' money to save your money. So in this particular case, I assume that you're borrowing somewhere the $15,000. Let's say you have a home equity line of credit. Okay. Now you borrow from your home, from your line of credit, $15,000, and you're putting it to the mortgage. So what happens actually now, because you pay such a big amount once, you're skipping months because you're now pretty much jumping all those steps. You're just skipping them, okay? That means you still pay your principal, but nothing goes to the bank during those months. And in this particular case, you will save $20,000. So by paying $15,000 into your mortgage, it saves you $20,000. And why? I will show you here. Look, on the left side is your interest rate payment, or are your interest rate payment. On the right side are your principal payment. Now, because you paid $15,000, that's all those numbers. If you add them together, it's 15,000. You save all those numbers on the left side, which are the interest rate. So you're saving lots of money by doing prepayment. And I am pretty sure that you agree with me that this is a good idea. But the big question is, okay, yes, I prepaid $15,000. I shorted my amortization by a lot. I saved $20,000. But now I have $15,000 additional debts that I borrowed somewhere from line of credit or so. With all-in-one, you don't need to borrow it somewhere because it's all integrated in the system, okay? But in this particular case, I just make the scenario worse than it is with all-in-one. So you're borrowing it somewhere else, you're investing $15,000, you're saving $20,000, but now you have to pay off your $15,000 somehow. If you would not do any payment, any principal payment for the $15,000, and you will pay just the interest rate on a home equity line of credit, it will cost you in the first year $667. Okay? Now, but you're paying it off, and let's say you would be, forget about it, you probably think it's not possible. How am I supposed to pay off $15,000 a year? Where I supposed to get the money from? I will explain you where. But let's just assume you paid it off in 12 months because you paid in, your beginning balance was $15,000 and less. So if you will be able to pay it off within 12 months, you just lose on the interest rate from the $50,000 if you were using HELOC rates, which is, let's say, 4% or 3.5%. If you use HELOC rates, so you lost $221, but you saved $20,000. So what you do, again, you borrow again $15,000, you put in on your mortgage, and you do the next step. Then it's like a next step, right? But let's say it takes you 2 years. You will not be able to pay off the $15,000. You need 2 years to pay it off. It will cost you, within 2 years, it will cost you $485. You lose $485, you save $20,000, and you are mortgage free faster. Okay? Now let's go to traditional bank. That's how everybody does the banking in Canada and US as well. You have your checking account, you have your saving account, and you have your mortgage. You work really hard. What happened with your money? You deposit in your checking account. Guess what it's doing on your checking account? Absolutely nothing. The bank are paying usually 0.001% in interest rate. Now you have a little bit money left over, you're putting on saving account. How much you get in saving account? If you're lucky, maybe 2%. If you do active investments, yes, you can do a lot more, but you're also adding a risk. So again, you're working hard for your money, but the money is not working hard for you because you're putting in a checking account and pretty much there's no benefit from the money, right? Because it's just sitting there and it's not just you're not making any money. To be honest, especially right now with the inflation, which is through the roof, your money actually is losing, I would say, annual interest rate of about 7%, okay, instead of making any interest rate. Now, I like to use this example because you need to understand, yes, the banks are, the good people at the banks, but the number one goal from any bank is to make money, right? So if you give someone $10,000 because somebody is in need, let's say, right? And you tell him, okay, I will give it to you for a year. And I'm not going to charge you any interest rate just because you're my friend. And then 6 months later, you need the money. You go back to this guy and just say, you know what, sorry, I need to get my money back. And your friend says, absolutely no problem. Here are your $10,000, but I will charge you 4% interest rate. What would you think or what would you say? What kind of a friend you are? Probably he will not be a friend for you anymore. But this is exactly what's happening with the banks all the time. If you make money, you deposit in your checking account, they're not giving you any money, any interest rate. But if you borrow money, they're charging you for your own money. There's absolutely no logic in it. But that's how everybody does it, and nobody thinks about it, that this is not right, this is wrong. Why would my money work for me? Why it's supposed to work for the bank? And just so on average, our 5 big banks, RBC, TD, Scotia, Bank of Montreal, they have approximately $450,000 sitting on checking account every day where they're not paying any interest rate to the clients. but they're using those funds to, if somebody needs mortgage or loan, they're just lending out the money and collecting interest rate. This is wrong, but that's how everybody does it. And that's why I would like to show you a different way where you could save a lot of money, and where finally your money will work for you, your hardworking money will work for you and not for the bank. If you go to the bank and you will ask them, what are my best and the best options that I have to pay off my mortgage? That's those three options they will give you. Bi-weekly payments, additional lump sum payments, or you pay additional money whenever you have money, or increase monthly payments. Okay, I like the last one, because to be honest, if we present, me and myself, my team, I have 10 people working for me. If we present the options to client, we tell them, look, you have an option to do additional payments. They're excited. That's great. I can do lump sum payment up to 20%. Honestly, everybody is happy, but nobody does it. That's how it is. 75% of Canadians unfortunately live from paycheck to paycheck. So that means forget that somebody will do it. But if you increase the monthly payments, then you're pretty much forced to pay, and that's the only option that works. If you would ask me, what's the fastest way to pay off the mortgage? This is my suggestion. Not bi-weekly, not additional payments sometime, not increase the payments. I do every money you make, every dollar you make from your payroll, your paycheck should go straight into the mortgage, without any delay, not checking account or saving account, and maybe something will be left over, will go to the mortgage as additional payment. No, your paycheck straight to the mortgage, your wife's paycheck straight to the mortgage, child tax benefits straight to the mortgage, tax returns straight to the mortgage, any bonuses straight to the mortgage. There should be nothing in between. Every dollar should go straight to the mortgage and pay off your mortgage. Here's the beauty of the all-in-one account, that with your traditional mortgage payments, within a month, the money is not doing anything. Okay, you can do additional payments mid of the month. It's not saving on interest rate because the calculation is once a month. With all-in-one, the calculation is daily. That means your money came in right at this moment, your mortgage balance drops, and you don't pay interest rate. And I know what you think. Okay, I know, it makes sense. If all my money goes in right there without any delays, I know I will pay off my mortgage faster. But the big question is, how am I supposed to exist? How am I supposed to live? I need to eat, I need to drink, I need to travel, I need to pay my credit card bills. If everything goes to the mortgage, where should I get the money from to live? And that's the beauty of the all-in-one account. You will not have a saving account, you will not have a checking account, you will not have a mortgage, you will not have a home equity line of credit. Everything will be one account. That's why you tell your employer, deposit my paycheck in my new account. This is your new checking account. That's why every money comes in saves you lots of money. Even if it's there for 3 days, 4 days, 5 days, you're not gonna pull the money out right away, right? It's gonna stay there until you need to pay some kind of a bills. And one thing is very important to me. Lots of people don't understand. If you pull the money out, it's not that now I'm borrowing the money, I'm paying interest rate. No, that's not the case. If you put the money in, it saves you interest rate during the time the money is there. If you pull the funds out, whatever you pulled out just stops working for you. It's not that you pay interest rate for the money that you're borrowing. No, it's just the money that went in, worked for you for 3 days, 7 days, week, 2 weeks, 3 weeks, and it stopped working for you. Okay? This is why this product is revolutionary. Because now every dollar goes straight in the mortgage, and it works for you for about 4.5% instead of sitting at 0%, or now with inflation even more. I just want to give you a couple examples. This particular person, for example, we compared his mortgage with traditional mortgage, and you see that he saved $90,000 on interest rate, and he is done with the mortgage 13 years, within 30 years, and not 25 years. And here you can see for us it's important, if we do a presentation to a client, we always show the client the real numbers. We use his real expenses, his real income, and we compare his existing mortgage with this one. And I always say to a client, even if I will find you a mortgage with 1% interest rate, you still will be ahead with the all-in-one product, because now all the money works for you. So even if the rate on the all-in-one would be a lot higher, and I will find your mortgage with 0 interest rate, you still will be ahead with this particular option. And specifically, if you're talking about VS all-in-one, this is not a traditional all-in-one product, because finally, I mean, banks are still banks. They still want to make money, right? And sometimes clients asking me why the bank is even offering this option, why they're doing it. Yeah, because of cross-selling. You know, they do lots of insurance and investment and so on, which you don't have to do, because we do insurances, we do investments, and I always say we always pick the best. You know, this bank is great for this mortgage option, but if you need insurance, there's something better. If you need investment, there's something better. And my guys are licensed. We offer everything, anything you can imagine in the financial industry. Okay, before I finish the presentation, I would like to do one more comment. If you go to your banker and you will ask them, and I actually recommend, right? What do you think about this all-in-one option? Don't mention VS all-in-one, because this is my customized product that we use for the client, which we offer uniquely. And maybe before I will continue, I will mention one more thing. I said to you in the beginning that I'm a top 30 in Canada from over 20,000 mortgage brokers. I'm number one in my province for many, many years. But for selling this particular product all-in-one, I'm number one in the country. So if you will contact the bank and just ask them, who is your number one mortgage broker in Canada? They will tell you Victor Schaefer from VS Solutions. Okay, so for me it's important that it's not just saying, you can call and you can double check and they will confirm to you. But if you go to your banker and you would ask them, what do they think about all-in-one product? 90% of the bankers have no idea what we're talking about, because there are only two banks who offer this product. And they probably will say it's not good and so on, but then maybe ask them a question. So what do you think, why it's not good? And you will realize this person has no idea what he's talking about, because again, he just doesn't want to work against himself, right? Because they don't offer this option. But there will be 10% of lenders who know this product or maybe heard about that, and then they will say, you could do exactly the same with us. You don't need the all-in-one, because keep in mind, if I do a mortgage for you and you, let's say with RBC will lose only mortgage. If I do all-in-one, RBC will lose everything. They will lose your mortgage, they will lose the checking account, saving account, because now we're combining everything with saving money. They don't want to lose you as a client, okay? But then I always tell my clients, or if you go to your banker, ask them the question. Those three questions you see right now on the screen. The first question, if you have similar product like all-in-one, can you show me a calculator? Because this guy showed us a calculator where you include all your income, like literally we include all the income that you have, and then we include all your expenses, your child payments, or let's say you have a childcare payment or some other payment that you have your hydro, your telephone. If we do our report, we'll include all your income, all expenses, and then the report tells us how fast you'll pay off your mortgage. Ask them to give you such a calculator. They don't have it. They have only some lump payment, bi-weekly payment, or increase the payment. That's everything they have. Number two, ask them for a statement. Can you show me a statement, how the statement looks like? If you have clients like this, remove the name, remove account number, but show me how the statement looks like. They don't have it. In this particular with all-in-one, you have a statement where you see a nice graph, how your mortgage goes down every month. And then the beauty is also on your app, you see every day your mortgage balance. That motivates you actually to save money, right? And not to waste money. So, and the last question, this is the most important one. Ask them, can I deposit my paycheck? Because the lender will tell you, you can do the same with us with home equity line of credit. You can deposit money whenever you have it, and you can reborrow. That's true. But that this will work, everything has to go automatically. Because if you have to do manually all the transactions, you're not going to do it. You maybe going to do it for a year or for a month or two, and then you will give up. So here you don't need to do anything. All the money goes in automatically, and all the funds go out automatically. But with your bank, you will not be able to do that. The banks do not allow payroll deposits in your home equity line of credit. That's unique to all-in-one product, okay? I also always, before I finish, I always in the event as well. Again, my events are usually 2 hours, and I'm trying to squeeze in everything in 15 or 20 minutes. I always like to ask them why people are buying at Amazon and why Amazon is growing like crazy. Before at the time when COVID started, actually, I did a presentation on Facebook Live, and I recommended to buy Amazon because I knew that Amazon is going to do well, and the price went up from 1,600 now to 3,000, whatever. So, but why the people are buying at Amazon? And then you had answered, it's cheaper, and it's not really the case. It's not always cheaper. It's more options, but the number one goal or reason is convenience. The reason why people like Amazon is convenient. I click, and it will be delivered to my home. That's why I say That's why all-in-one works, because you don't need to do anything. No move, every single bit done automatically. Your paycheck comes in, your expenses go out, but at the time the money is there, it works for you. So again, just to recap, advantage of all-in-one. Now all the money goes straight in your account, pay off your mortgage. The second advantage, whatever you paid off is now available for you. So you pay, let's say you had $500,000 mortgage, you paid down 100,000, now you're at 400. Your checking account will show 100,000 available limit. You can borrow anytime the funds without asking the bank for mortgage rates, not like a loan rates, right, or credit card rates. You can borrow from, you reborrow your money back for a low rate, and thanks all-in-one, you will pay it down a lot faster. You have to be careful. I mean, you have access to a huge amount of money without asking anyone. I want to make sure that people, and we do actually a test before we offer this product to clients. We do a small test if the person is the right person for this product. But I would say 95% of my clients are the right people, especially after education. Nobody else does this education. I can tell you, this is not a profitable business for us as a mortgage brokers. It's a lot more to explain, a lot more work, and we get 30% less commission. Okay, and then lots of my colleagues don't like to offer it because it's very time consuming and it's not really profitable. I like it, and I always teach my kids this way. You know, whatever you use self, that's what you need to offer your clients. And that's how I build my business, and that's what I use myself and my employees, and that's what I like to present. And we definitely still make money because of our volume. We do lots of those deals. And let's say one day you paid off the mortgage. Victor Schaefer, VS Solutions, my team helped you to pay off the mortgage. Believe me, it's a crazy feeling. The air smells different. The grass that you walk on will feel different because now you don't have a mortgage, but your paycheck still comes in. There's nothing to pay off. What happens? Now your checking account shows positive balance. And the bank is paying you interest rate on checking account, which nobody else does. This particular bank does. But again, if you have a little bit more money, then it doesn't make sense to keep it there. It makes sense to invest. And lots of my clients, to be honest, they're paying off the mortgage faster, but at the same time, they're using they're doing investments, and you know, it's nice to have both. It's nice to be debt free by the time you're retired, but it's also nice to have a couple $100,000 in your RSP in tax-free saving account, and you can definitely do it with the all-in-one product. It's also great for people who have income fluctuation, like self-employed people. You know, they have a good time, good year, and whatever, they have money, they would like to do additional payments, but they're concerned, what if my next month will not be looking good and now I paid in everything in the mortgage? So the beauty here is you don't need to think about it. Money goes in, whenever you need it, you take it out. Okay? If you have any questions, just give us a call. The phone number is on every screen that you saw. You can send us an email, save@vssolutions.ca. You can visit my website, vssolutions.ca. You can join me on Facebook. So if you have any questions, by all means, we will be more than happy to answer your questions. If you need to find me, just type in my name, Victor Schaefer, in Google, and you will find everything about myself, all my contact information, and so on. And if you like the presentation, I would appreciate if you will share it with your friends. Believe me, they also would like to pay off the mortgage faster, and there is nothing better than this particular revolutionary product. That's it for today. My name is Victor Schaefer, and if you have any questions, just give us a call. And until the next time, I guess, in the virtual world.